So they're buying so much gold every single month as the price is doing nothing. You look at the central banks, the largest first quarter ever. The second quarter is coming in super strong as well. You look at all of the central bank buying. They said it was the most they ever bought and lied about it by a factor of 15, 244 metric tons. And when you talk about a metric ton, that's 244 times 32,150. That's 7,844,600 ounces of gold that was bought in the first quarter that we know of by the central banks. Call it times 4,000 even, and you're at 31,378,000,000 that the central banks had bought in the first quarter that we know of. The Bank of Korea resuming physical gold purchases for the first time in 13 years.
Gold and silver are moving through a market where speculation has cooled, yet major buyers continue building positions. Beneath the quiet price action, monetary pressure, expanding liquidity, and persistent inflation are creating conditions that deserve close attention. Andy Schectman, a precious metals commentator known for discussing monetary policy, central bank demand, and systemic financial risk, emphasizes that sophisticated investors are recognizing how dependent markets have become on liquidity. He argues that policymakers cannot easily withdraw support without breaking something, especially as debt levels make higher interest rates increasingly difficult to sustain. His prediction is that inflation will remain persistent. Purchasing power will keep deteriorating, and authorities will ultimately rely on more liquidity, rate cuts, or forms of yield control to stabilize markets. If real rates continue falling or turn negative, gold and silver could attract stronger institutional demand as investors seek protection from currency debasement. He also sees large buyers as front-running this shift before broader public participation returns. This places monetary credibility at the center of outlook. Now, we present the clips from Andy Schectman's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Let's just take the central banks out of the equation, who are buying more than ever. Same with China. You look at Tether, they're up to 20 billion, but they bought another 4 billion just the other day, over the last 4 weeks, I should say. They had 4 billion. They're buying more. Let's take all of them out of the equation, and I'll answer this in a way that that I probably wouldn't answer it this way, but I'll answer it in a way maybe the mainstream would answer it. And forget about the central banks, forget about the commercial banks, forget about all the deliveries. I think that the sophisticated trader, the big money, smart hedge fund, JP Morgan, these guys are, I think they realize the irony of the market, that the broader and higher these markets go, the harder it becomes for the policymakers to ever meaningfully remove the liquidity supporting them without breaking something. And when you see M2 going to the moon right now, that's exactly what I mean. When you see intervention to keep Japan from selling treasuries, that is what I mean. When you see supposedly this little country in the Cayman Islands owning as many treasuries as they do, this is what I mean. And again, I want people to, for a moment, realize that it's not just treasuries that would be affected if Japan sold treasuries. It's not the treasury market. This carry trade has propped up the equity market as well. And I think that what you are seeing is the realization that the answer to every problem eventually becomes more liquidity, more debt, more currency creation. I think it's safe to say the era of aggressively shrinking the Fed's balance sheet appears to be over for now. What happened to quantitative tightening? And now they're adding 40 plus billion a month. They don't call it QE, but that's exactly what it is. And bailing out Japan wasn't bailing out Japan. It's yield curve control. Call it what it is. And I think long term, the debt is not sustainable. It's that simple. And I think markets are beginning to understand that. And what that would mean in a free market is that these markets would push interest rates higher. At that point, our indebtedness becomes even less sustainable, forcing the Fed to cap rates. And that's where we're at. And a rate that can no longer rise fuels inflation as a release valve. That means that real rates fall or even turn negative. And I think the market is beginning to realize that. And so you have sophisticated traders, if I were guessing, like really smart technical traders that are front running gold, because I think they understand that through all of this, you have a Fed that is trying to redefine what inflation is. And if they change how inflation is measured, they can make the numbers appear closer to their 2% target, which they haven't hit in over 65 months, creating this political and financial cover for more rate cuts and more liquidity and more printing and more buying, or the whole thing blows up. And I think they understand this, and they can make inflation look better on paper while everyone's purchasing power continues to get worse in reality. And again, I've said it in other ways. You measure things in dollars, they're getting more expensive. Measure it in gold, they're deflating. And that's the moral of the story is inflation ain't going anywhere. Peter Schiff was right when he said that. When everyone was talking rate hikes and slowing the economy, he said it ain't going to happen, and it's going to be more and more and more inflation. And he's right. It ain't going anywhere. I think, in other words, we're going to sacrifice our purchasing power to preserve the government's power more than anything. So, I think that's the most important thing to me. I just think that it's showing you that gold and silver have sniffed it out. They're sniffing out the real yields, and the big money understands that. Normally when you see the kind of gains that we saw Friday, you would expect a big sell-off on Monday. Didn't happen. It's holding very tight. It seems to have shook out all of the speculation, all of the open interest. No one even notices that gold and silver are coming back up. No one even notices that silver's back to 65 and gold's at 4,400. It's meaningful. And, corrections are necessary. It got overextended. It brought in too much froth, too much speculation. But we are beginning to see that it is quietly resuming its march higher in an environment where all the speculation is gone. They've brought their toys to a different sandbox. They're speculating in AI or whatever the hell they're doing. They're certainly not in the metals market. And the most important thing for me through all of this 6 months of difficult market action is that the central banks have bought more than ever. And look at China, right? I'm just going to read some of their purchases that they've told us about. JP Morgan or Goldman Sachs says, no, they're underestimating by like a factor of 4.5. But here are their purchases that they've declared in gold. 40,000 ounces in January, 30,000 in February, 160,000 in March, 260,000 in April, 320,000 in May, 80,000 in June, and 640,000 in July. That's what they're telling us, right? So what is 640,000 times, call it 4,400? I don't even know if my calculator will go that high. 281,600,000, maybe that's what it is. But that's what they bought in June. So they're buying so much gold every single month as the price is doing nothing. You look at the central banks, the largest first quarter ever. The second quarter is coming in super strong as well. You look at all of the central bank buying. They said it was the most they ever bought, and they lied about it by a factor of 15, 244 metric tons. And when you talk about a metric ton, that's 244 times 32,150. That's 7,844,600 ounces of gold that was bought in the first quarter that we know of by the central banks. Call it times 4,000 even, and you're at $31,378,000,000 that the central banks have bought in the first quarter that we know of. The Bank of Korea resuming physical gold purchases for the first time in 13 years. And you get to Tether and you wonder, why is Tether buying so much gold? And, where is it all going? I've told you my thesis on that before, but here it is again. And, they're buying more gold than anyone in the world, even more than China, except the Central Bank of Poland. And it's crazy what's happening right now in terms of gold and silver accumulation as the price is getting beat up. I think that's really the most important thing to understand is that, over the last 4 weeks, Tether has bought 701,000 ounces of gold. And what is that? That's almost $3 billion over the last 4 weeks. I mean, this is a crypto company buying gold. These are central banks who print money buying the one thing they can't print, gold. The biggest money who understands the system is using the drawdown in price, the drawdown in open interest, the drawdown in any recognition. And after all of the carnage there, they're using it as a tool to buy it on the cheap and without people noticing.
The strongest signal in precious metals is not coming from retail speculation, but from the scale of physical accumulation. Central banks have continued buying gold even during months of difficult price action, while China has reported purchases, and the Bank of Korea has resumed buying after a long absence. Tether has also become a buyer, adding hundreds of thousands of ounces within weeks. That stands out because a crypto company is directing billions of dollars toward the same asset central banks are accumulating. At the same time, speculative interest in metals has faded, open interest has fallen, and much of the market's attention has moved toward areas such as artificial intelligence. The contrast is important. Price weakness has not stopped large institutions from accumulating physical metal. Instead, the drawdown has provided them with an opportunity to buy quietly, while public attention remains elsewhere. Now, let's get back to the interview.
We can take your treasuries if you're Russia and you aggravate us, and if you own enough of them, you're going to sell them when we tell you it's okay to sell them and how we tell you, because you're going to blow up the markets. This is, again, further, I think, eroding the trust of the entire system underneath it. What they are not saying is far more important than what they are saying. And it's sold to the public as we're being benevolent and helping our friends, Japan, to support their yen. The hell it is. If the yen goes too low, their rates have to go up. If rates go up, the whole carry trade explodes and all that money goes home. And so they're not doing that. They're doing it to support our bond market and price discovery. And it goes to show the fragility of the markets when you have intervention. All interventions end poorly. It's the butterfly effect. You watch all those movies where they go back in a time machine. Now, don't touch anything, don't talk to anyone, or you're going to alter, you're going to alter the future. Well, it's the same thing here. When they do one thing, the second and third effects down chain, well, that's what we're seeing right now. And this is the distortion and perversion of asset prices in a period of time where interest rates in Japan and in the U.S. were very, very, very low. And too many people, by the way, are focusing just on the effect it will have on the bond market. I would argue that a lot of this money that has been borrowed at zero or behind zero, as the Japanese rates have been zero or negative for the last 30 years, has gone into high tech. It's not just into treasuries. They're buying the hyperscale build out story. So if all that money yanks home all of a sudden, what happens? And everyone is jammed in. You got the public all in on stocks to the highest level ever in 12 stocks, with the largest exposure by far of margin debt. While the Buffett indicator is 240, it is way higher than it's ever been at any market peak in 2008 or 2000. So you got way overvalued markets. You got the public all in those markets at all-time high on margin and all-time high on option exposure. So they're leveraged and speculating in the handful of stocks at the highest valuations ever. As the carry trade is it's right on the edge. I mean, at some point, when does Japan have to take care of Japan? And really, the only thing that they could do to make things normal, to make a currency relevant, would be to raise rates. But that's going to create a global financial pandemic quickly. And so this is what happens when you distort things for a long period of time rather than letting the market find equilibrium between risk and interest. The bankers thought that they had a better way of doing it, and this is the knockdown effects that we are beginning to see. So the story is not over on this, and it has less to do with Japan and more to do with the fact that if Japan sells the one asset, this supposedly super, all the dollar bills say, well,
deepest, liquidest. Yeah.
It's the most liquid rails in the world. Is it really? Because look what happens when someone who's holding over $1 trillion in our treasuries wants to sell $50 billion. Oh, no! That's a problem. Flies right in the face of everything we've ever been told about why the U.S. is impossible to take over because of the liquid and smooth rails of the bond market. Is it really? I would argue it's beginning to show its fragility. It's beginning to show, it's not what we're being told, and that's a big problem. It's a big problem in a world where everything's based on confidence, and I think it's also the recognition that one of these currencies goes bust, it pulls everyone down with it. And the same thing would be true with the euro, with the pound, with the, in this case, the yen. They're all connected, interconnected, and so I guess we'll see. But yeah, it has nothing to far less. And an interesting counterpoint to all this too is that if they come in and support the yen, that they can't support it too much, right? They're trying to walk a fine line, because if they support it too much and the yen goes too high, remember all of those people who've done the carry trade that are already over on this side and sold the yen bought the yen at zero and very low value on the yen and zero interest rates, and then they buy it, then they sell it to buy dollars to buy Nvidia and treasuries. Well, if the yen goes too high, forget about if they cap yields, but they just let the yen go high. Well, the people over here have to then buy back yen at a much higher price, killing the incentive to hold the trade. So if it goes too high, the trade unwinds. If it goes too low, their interest rates go up and the trade unwinds. And so, this is alchemy. They're just trying to find the right mix, not too high, not too low. Going to sell your treasuries? No, we'll lend them to you. The whole thing is it's dizzying. And I would hate to be War Shore-Besant right now trying to play maestro to this orchestra.
Japan's role in global markets goes far beyond its own currency. Years of extremely low or negative interest rates encouraged investors to borrow yen cheaply and direct that capital into U.S. treasuries, technology shares, and other risk assets. This carry trade became deeply connected to both bond prices and equity valuations. The discussion highlights how official intervention can distort normal price discovery. Support for the yen and efforts to prevent large treasury sales are presented as measures that also protect broader financial markets. When authorities intervene in one area, the effects spread through other markets because the same borrowed capital supports multiple asset classes. Another concern is concentration. Public investors are heavily exposed to a relatively small group of major stocks, while margin debt and options exposure are elevated. At the same time, valuations remain stretched, making the system more sensitive to shifts in liquidity. The broader point is that years of artificially low rates have encouraged leverage, speculation, and dependence on policy support rather than allowing markets to find a natural balance between risk and interest rates right now. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.